All right, let's talk Hertz. As of the market close yesterday, November 4th, 2025, Hertz, ticker HTZ, finished the session at $6.73 per share. But that price doesn't even begin to tell the story. The stock absolutely exploded, finishing the day up a staggering 36.23%, a move of $1.79 on massive volume of nearly 130 million shares. Now, the immediate expectation for anyone who has followed this name is simple: disaster. The common belief, especially for those doing self-investing and watching their Robinhood app, is that Hertz is a broken company, a post-bankruptcy zombie still reeling from its catastrophic bet on electric vehicles and weighed down by a mountain of debt. The narrative has been one of survival, not success. But here's the reality that just hit the market like a freight train. Yesterday's 36% surge was fueled by a third-quarter earnings report that completely defied those rock-bottom expectations. For the first time in 2 very long years, Hertz actually posted a positive adjusted earnings per share. The company reported 12 cents per share, smashing the 7-cent consensus forecast. This wasn't just a small beat, it was a fundamental signal that the company might not be sinking after all, forcing every analyst and trader to rethink their entire thesis. The common ground we all share on Hertz is the skepticism. This is the company that fumbled its massive Tesla stock order, finding that the repair costs and rapid depreciation on EVs were a financial nightmare. For many individuals using online investing platforms, Hertz became the poster child for a meme stock rally that had no basis in reality. It's the kind of volatile name that would almost never find its way into a stable, long-term portfolio like a Schwab Intelligent Portfolios account or a diversified Fidelity mutual fund. It's seen as a pure gamble. But the contrarian take, the one the market is now being forced to consider, is what if the new management's back-to-basics strategy is actually working? What if the EV fleet disaster, as painful as it was, is now largely in the rearview mirror? The reality check from this quarter's numbers is that the company generated $190 million in adjusted corporate EBITDA, a $350 million improvement year over year. They also generated $250 million in positive adjusted free cash flow. These aren't just numbers on a page, they represent a potential stabilization that almost no one saw coming. Let's break down this recent movement because it's critical. That 36% pop wasn't a random no-news spike. It was a direct reaction to management proving it has a handle on the single most important metric for a rental car company: vehicle depreciation. For quarters, the story was that their fleet was costing them a fortune. In this new Q3 report, DPU came in at $273. This is a massive improvement and is finally approaching their target of getting that number sustainably below $300. This is the core of the bull case. They are aggressively refreshing the fleet, which is a corporate way of saying they are dumping the unprofitable EVs and replacing them with more predictable, profitable combustion engine vehicles for 2026. They are also getting smarter about selling them, increasing their use of direct retail channels like Hertz Car Sales by 570 basis points, which fetches better prices than wholesale auctions. Furthermore, they drove vehicle utilization up to 84%, the highest it's been since 2018. They are sweating their assets more effectively. This is the operational turnaround that investors, whether they're using SoFi Invest or a high-end Fidelity brokerage account, have been desperately waiting to see. The trading volume confirms this was an institutional-level event. This wasn't just retail investors on Robinhood stock trading platforms. This was a major reevaluation by larger funds. Now, before we get too optimistic, let's look at the other side of the ledger. This is where the expectation of disaster still holds a lot of weight. the balance sheet is still incredibly risky. Hertz is sitting on $2.2 billion in liquidity, with $1.1 billion in unrestricted cash, which sounds good, but it's carrying an enormous debt load, estimated at around $20 billion. While much of that is asset-backed by the vehicles themselves, it's a terrifying number. Data shows their short-term obligations still exceed their liquid assets. This is not a fortress balance sheet like Apple stock or a high-growth momentum play like Nvidia stock. This is a company with a huge amount of leverage in an economically sensitive industry. If a recession hits and travel demand falls off a cliff, or if used car prices collapse again, that debt load becomes an existential threat. This is why many professional traders using sophisticated tools like the Interactive Brokers trading platform are likely looking at this 36% pop with suspicion. They're looking at the bond market, at the credit default swaps, and asking if this one quarter of good news is enough to offset that massive structural risk. This is the kind of investment that can wipe out an individual brokerage account if not handled with extreme caution. So, what does Hertz actually do for those who are new to the story? Hertz Global Holdings is one of the largest vehicle rental organizations in the world. It operates the flagship Hertz brand, as well as the Dollar and Thrifty brands, targeting different segments of the travel and leisure market. They rent cars, vans, and trucks to a mix of business and leisure customers at airports and off-airport locations globally. The business model is simple on the surface. Buy cars, rent them out, and then sell them. The entire business hinges on a complex financial balancing act, managing fleet acquisition costs, maximizing rental days or utilization, and rental price or rate, controlling operating expenses, and, most importantly, accurately predicting the resale value of their cars. When they get this right, it's a cash flow machine. When they get it wrong, as they did with the EV fleet, the depreciation costs destroyed the entire profit and loss statement. The company famously went to bankruptcy in 2020, was relisted, and has been on a wild ride ever since, becoming a battleground stock for bulls who see a classic travel recovery play and bears who see a terminally flawed business model. This recent Q3 earnings report is the first concrete piece of evidence that the bull case might have legs. The management team, led by CEO Gil West, has been adamant that their back-to-basics plan would yield results. They seem to be delivering. They've improved their Net Promoter Score in North America by almost 50%, a sign that customers are noticing the newer fleet and better service. They've secured their 2026 model year fleet at predictable pricing. These are the boring operational details that don't make headlines, but are essential to making the business work. This is the kind of detail you need to look for when you're doing online investing and trying to find real value, not just hype. It's the difference between gambling and making an informed investment. Many investing sites will just show you the 36% jump, but the why is buried in these depreciation and utilization metrics. For anyone looking for investment help, this stock is a perfect case study in separating a narrative from the numbers. The narrative was death. The numbers just showed a pulse. So, what is the future outlook? This is where the tension between expectation and reality gets fascinating. The new expectation, fueled by yesterday's rally, is that this is the bottom. The bulls will say the worst is over. The EV headwind is now a tailwind of fleet optimization, and as DPU stays low and travel demand stays high, the company will rapidly generate cash and begin to deleverage. They'll point to the $1 billion EBITDA target for 2027 as achievable. But the reality check is severe, and it's coming from the analyst community. Despite this massive earnings beat, the pros are not jumping on the bandwagon. Bank of America, for example, reiterated its underperform rating on the stock just yesterday, sticking with a $3.10 price target. That analyst is essentially saying this 36% pop is a sugar high, and the stock is still worth half its current price. Their argument is that the structural issues, the debt, the competition from ride-sharing and peer-to-peer rentals, and the macroeconomic sensitivity are not solved by one good quarter. The consensus rating remains a hold. This is a profound disagreement. The market's reality, a 36% price surge, is in direct conflict with the expectation from major analysts that the stock is still a sell. This is what makes this stock so difficult to handle for the average person doing self-investing. Do you trust the momentum and the company's own report? Or do you trust the analysts who are paid to look at the long-term risks? If you're using a platform like Fidelity, you have access to this research. You can see the Fidelity ETFs that might hold Hertz, or use the Fidelity trading platform to set complex stop-loss orders. If you're on SoFi, you might be torn between the SoFi stocks you can trade actively and the safety of a SoFi ETFs portfolio. This is not a stock for a simple intelligent portfolio. It's an active high-stakes debate. Even Robinhood investors